Welcome to Bar Chart's series of educational webinars designed to enlighten you on a variety of investment ideas and concepts, to inform you of the features and tools related to these contracts that are offered by Bar Chart, and to give you some traders' insight to help you make a more informed investment decision. Today's session: successful strategies for analyzing, advancing, and declining stocks. Now, the number of stocks advancing or declining is an essential part to discovering market sentiment and trend. Now, these types of analysis is referred to as market breadth. And breadth examination is a tool to determine the overall market trends, participation, health, and internal strength. However, since the year 2000, the parameters of many breadth indicators' reliability has come into question. And one reason is the explosion of ETFs, bond funds, leverage ETFs, REITs, and ADRs, because a lot of these are not directly related to corporate economic activity and the traditional market discounting mechanism. Nonetheless, breadth indicators have evolved into better tools for identifying divergences and extremes than confirmation. However, breadth analysis can be a valuable tool to any investor's toolbox, being that of secondary confirmation or just identifying changes in acceleration of prices rather than direction. Hello, everyone. My name is John Rowland, Bar Chart's Senior Market Strategist. And today's session is about understanding breadth analysis, ways to measure breadth, standard breadth indicators, their purposes, and Bar Chart's unique array of special symbols, many of which can give Bar Chart subscribers the opportunity to create, shape, and granulize them into personalized breadth indicators. And then along the way, I will show you some of the different ways I use these symbols to dissect market breadth. So stick around as we explore and analyze advancing and declining stocks and market breadth strategies. Now, before we get to all that, please welcome Bar Chart's project director and our moderator for today, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
Very well. Good afternoon to you as well. Are you enjoying the lovely weather? I hope you didn't avoided some of those bad storms last night.
Oh, they actually didn't even hit here at all, but we are loaded with cicadas out here. So, kind of cool, kind of scary and creepy, but yeah, we'll get over it.
The invasion, right?
Yeah. Yes. All right. I know that you are covering some unique content that we have here on Bar Chart. So I'm going to turn it over to you and let you get going.
Thanks, Gene. Let's get this party started, as they say. All right, just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold, or trade securities, commodities, or any other investments involves risk and best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damage that you or anyone incurs as a result of any trading or investment activity that you or anyone engages in based on the information or material you receive through barchart.com and our services. Okay, so what is breadth, right? So market breadth really refers to the overall health of the stock market by examining how many companies or stocks are participating in its movements. And it can be measured by the number of stocks that are advancing, going up, versus declining, going down, within a given index or exchange. We're going to see that there's a lot of different ways or metrics to measuring market breadth in terms of advances and declines, and that we can granulize this at not only the index or the exchange level, but also among sectors. So many stocks if they're rising, this kind of suggests a strong breadth and an indicating of a broad participation and potentially strength in the market. And conversely, if only a few stocks are rising while all the others are falling or trading sideways, this would suggest a weaker market breadth and may signal a potential market reversal. Now, here's where breadth can be subjective. Now, if we look at recent history, it has shown that a few stocks did drag along the many. And we could think about, the take on the Magnificent Seven versus the rest of the S&P. So, what is the purpose for using breadth indicators? Well, first, for market confirmation. When a market is trending upward and we have a strong breadth, that typically is accompanied by the trend reflecting a broad-based participation of many stocks or the sectors. And conversely, if a stock is rising and our breadth indicators are weak or declining, now that may indicate of a lack of widespread participation and potentially signaling a weak or an unsustainable trend. Now, divergence is a big part of using breadth indicators. Now, divergence basically means that we'll see that there is a difference, let's say price movements and breadth indicators. In other words, if prices are going up and breadth indicators are going down. And this can provide an early warning of potential trend reversals as well. Now, divergences take time. And typically, breadth indicators peak or trough before prices. Confirmation of breakouts or breakdowns. Now, breadth indicators can confirm the validity of a breakout or a breakdown in price trends. If a market index is breaking out of new highs and is accompanied by strong breadth, it adds credibility to that breakout and suggests further upside potential. Assessment of market breadth. So, breadth indicators allow investors to assess the extent of market participation across different sectors, industries, or even asset classes. Now, by analyzing breadth metrics such as advanced declines, new highs and lows, or percentage of stocks above their moving averages, investors can gauge whether the market rally or decline is broad-based or confined to a specific sector. And long-term analysis. Breadth indicators can also be used to assess the sustainability of long-term trends. And a prolonged divergence between price movement and breadth indicators may be that signal again of the underlying weakness in the market and learning of a potential trend reversal, or maybe just something less ominous as a prolonged consolidation period. So there are different ways that we can measure breadth. Now, the first four here, we're going to take a little bit more examination of these a little bit later using our bar chart special symbols. That'll happen in a moment, but let's just kind of talk about what these represent. So advanced decline really is, did the stock finish up or down based on yesterday's close? We can measure breadth in terms of new highs or new lows as a benchmark. And again, there are many ways we can granulize new highs and lows. Now, in bar chart, we're going to offer you special symbols on monthly, 3 months, 6 months, 52 weeks, and year to date new highs and lows. But you can also screen on 2-year, 3-year, 5-year, 10-year, and 20-year new highs and lows. Advance and declining volume. So we can look at total advanced volume, let's say, of all the markets, or we can granulize this again by exchanges and percentage of number of stocks above a moving average. bar chart moving averages that are available for examination will be the 5, the 20, the 50, which is my favorite, the 100, 150, and 200 days moving averages. Now, there are many different types of breadth indicators or studies that we can look at, and these are just a few of them that we're going to talk about today. I really want to spend more time about using how to create your own breadth indicators, but we have the McClellan oscillator. We have new high low accumulation, and if we have some time, we might get a chance to look at this one. Um, the accumulation distribution Williams and the on balance volume. So let's start with these first. And so let's do this. So under the learn section, right, here's learn, you will find the heading technical indicators, and that will take you to a library of different technical indicator studies that we have and also what they represent. So I just want to just show you, for instance, here is that new high-low accumulation index. And this was created by Alexander Eldon. We're going to talk about him in a little bit later, but this is based on 52-week highs and lows. But what is interesting about this description is starting to hint about those special symbols that can be found on bar chart. So let's do this real quickly. Let me give you kind of the Reader's Digest version of a couple of these breadth indicators. So here we're looking at the Qs, the NASDAQ, and I've just put a couple of them up here for reference. And let me see if I can kind of get this going here. Okay, good. So one of the things we said about breadth indicators is divergence, right? And so let's look at a couple of these. So the first one here is the McClellan Oscillator. The McClellan Oscillator is very similar to a MACD oscillator. And what it does is it looks at net advances over two different time periods, 19 and 39. Now, the McClellan oscillator also allows you to source where that information is going to come from. So you can source all of total stocks, all is total stocks. Again, one of those criticisms of a lot of breadth indicators today because of the advancement or proliferation of all of these different types of equities. The NYSE, the New York Stock Exchange, or the NASDAQ. Since we're doing the Qs, let's focus on the NASDAQ as our source of information. So the McClellan oscillator, which is this pane right here, it really does a better job of discovering troughs than peaks. And it's useful for alerting us of divergence, but it can be used for confirmational analysis. In other words, when it's above the zero line, which you can kind of see here, that confirms upward prices. And as the oscillator crosses the zero line, that could be an indication of a change in trend. But we will notice as we do a lot of breadth analysis, again, I'm going to hammer this home, that breadth indicators can peak or trough before pricing. So here we can see that the Qs was rising, right? We have a rising Q market, but the breadth indicator, right, the McClellan indicator was falling. This is called divergence. And this would be an indication that maybe what we're seeing is not a strong participation from our market and that we could see a change in direction of price. And the confirmation would be when we cross over the zero line. And that's exactly what we saw here. Again, we see another divergence here, right? We see a couple troughs, higher lows, and at the same time, our index is trading lower. So again, a peak came before the actual peak low in prices. But again, what we could look for is that crossover the zero line and maintaining above that zero line would be our confirmation that we're now seeing a change in trend. The unbalance volume indicator, is a weighted volume series. So what does that mean? Well, what they do is they add up day volume to the index, and they subtract down day volume. And so as we have up days and that volume is accumulated, then the index will rise. So again, you could see some divergences. Now, I think in terms of using this one, it's important that we smooth the data, right? The data could change rapidly on a day-to-day basis. So that's what we see here on this purple line, a moving average where we smooth the data. The default for it is 20. I kind of prefer 40. I want to see a little bit longer period of time. But again, you can see that as the Qs was rising, our on balance volume was trading sideways to maybe actually starting to turn a little bit lower. And that's why we kind of want to wait for that moving average to start to make that turn. And then again, you can see here, we see that the moving average is actually starting to rise as um, our index is falling. Again, another type of divergence. And then we have the accumulation distribution Williams, which is very similar to the unbalanced volume. And the trade signals are basically these divergences. Again, as the market is making new or highs, if my indicator is not confirming that or agreeing with that, then that could be that sign that we're going to see a reversal in trend. Again, another one that has a smoothing moving average, and the default on this one is 14. Okay, so those are just basic uh, breadth indicators, and I don't want to spend a lot of time on them. Let's get to the fun. Let's get to where our creativity can really help us fabricate some unlimited ways of measuring breadth. So the first place I want to start with is on one of the pages that I visit every day. Now, I look at this page twice a day, once in the morning around 10:30, and again after the close. And this page is in our stock under the momentum. And what I'm looking at here is this gives me a quick breakdown of today's advance and declines, and it gives it to me in multiple ways. I can see 52-week new highs or lows. I can look at it in terms of volume. I can look at it in terms of the different shares or issues. I can look at it in terms of two different exchanges and across multiple moving average. So what am I looking for? Well, did the breadth from the morning change, or did it stay basically the same, or did it accelerate towards the close? So for instance, today was about 50-50 in the first hour, and you can see now we're starting getting this acceleration to more declines than rises or advances. So there are some strategies that we can look for. One is called a large down day, or what is called a 90% down day. And there's some elements behind this strategy that you can use. And so what we're really looking for is those declines have outpaced advances, and we want to see it at 90%. Today you can see that for the New York Stock Exchange, it's 64.34. So, maybe 85-15, I might kind of give it a little bit of a cheat factor, but these days are rare days when we see that 90%. So some of the takeaways. If it's a one-day event, an outlier, then it's really only kind of warning us that market sentiment is changing and that it really means that investors are starting to get a little bit jittery. If it occurs after a recent high, for instance, a 52-week high or a 6-month high, or it happens on a day where there was a catalyst, let's say an economic news story, for instance, like the Fed watch, something like that, then that's usually just a short-term correction. 2 or more days within a week period or a 2-week period will give greater probability that you will see other days of that 90% in the next, let's say, 30 trading days. And this is usually a sign of a bear market or a beginning of a very strong downtrend. Now, a big volume rally periods of 2 to 7 days often follow these 90% down days. And these are our V bottoms. I'm sure you're very familiar if you're an investor and you're watching stocks. You've seen these V bottoms before. And these are great short-term momentum opportunities, especially if you're trading options. It really gives you a bias to the upside. Now, major bottoms and reversals can be confirmed if immediately following our 90% down day, we have a 90% up day, or we have multiple back-to-back 80% up days. Okay, so let's do this. I'm going to go into details, and wait, let's do this before I go into details, because I want to make sure that show you there is an area where we can look at some of our special symbols. So let's do this. I'm going to go back to my slides. Whoops, not that. Whoops, bad. Whoop. Let's close that out. Sorry. I don't know why that came up. Let's do this. Go back to my slides. Yep, there we go. So we have some bar chart special symbols, and they calculate or disseminate unique data. And there's a lot of different ways we can look at it, either based on an index or an exchange, or actually, again, in some of our sectors. And this is just some of the main categories: summary of stock new highs, new lows, number of new highs and lows, advanced and declines by exchanges, and volume, and also by percentage of moving average. Okay, let's see if we can get this to change. And where is my bar chart? There it is. Okay, so I'm back at bar chart. So under the learn here, under bar chart resources, you can see where it says bar chart special symbols. And let's go there. And this is where you're going to find a lot of those special symbols. I'm going to show you some shortcuts to find these, but this is where you'll find most of them. So for instance, if I look at the S&P 100 and I open that up, here I'm going to get all those special symbols that are based on, let's say, those new highs and lows. If I go into here where it says advance and declines, I can open that up. And again, we'll get into this a little bit more details, our advanced decline ratios and our differences. So let's go back to let's see, market performance. This is where I was before. Yep, here we go. So what I did, let's do this again. So up here under details, there it is. Open that up. This is where you're going to find that short link or that shortcut to finding some of those special symbols. And again, total number of new highs and lows, advanced decline by exchanges, advanced declines by volume, and again, sorted there by some of our different exchanges. So let's do this. Let's go to what is the difference between advanced decline ratio and a difference? Well, advanced decline ratio is simply dividing the number of advanced stocks by the declining, where the advanced decline difference is a summation of advancing stocks versus declining stocks. In other words, a subtraction. So let's go to the ADRT, which is the total advanced decline ratio. Now I'm going to open that up, and it's going to open me up to a chart. Now, the first time you open this chart up, you're going to just see a lot of dots, all right? And so what I want to recommend to you is the first thing you need to do is go up here and change the chart into a line chart. And this is just going to collect the dots, connect the dots, so to speak. And if you look at this, this is a lot of noise, right? It's up and down, up and down, up and down. So how are we going to use this? Well, the first thing that we're going to try to do is we're going to smooth this out. And there's a lot of ways we can smooth it out, but one of the easiest ways we're going to smooth this out is by using a moving average. So I can come in here, add a study, and there are many different types of moving averages that you can use. Um, so that's exactly what I've done. I've added a moving average here. I'm using an exponential moving average, and I'm going to use a 21 period default. Now, depending on your timeline or how you want to analyze the market, um, you could frame the moving averages based on that. But some common moving averages that would use for breadth indicators would be 10, 21, 40, and 55 days. If you're looking at weekly analysis, then you might want to look at something like a 13 or a 40. So I'm using a 21 on this one. And that's what I did here. And what I did is I already have this loaded into this chart, but I turned it off. So I'm going to click on this little eyeball here, and it's going to turn it back on. Now, again, there's a lot of noise here, right? I still see that noise, and it's kind of on top of my moving average. So what I'm going to do here now is I'm going to go back to my total advance and decline ratio. And again, see this little eyeball here. I'm just going to click on that. And now I'm just looking at the moving average, right? I'm just kind of seeing this really smooth moving average. And so what do we see here? Well, how can I read this, or what is this kind of telling me? Well, what I see here is that the 21-day moving average of advance to decline since October of last year has been above the value 1, except for one moment. Now, 1 would be that equal advances versus declines. So above 1 would represent more advancing stocks than declining stocks. Now, I don't know what the S&P would be doing, but we could assume that if we see more advancing stocks over a longer period of time, that we probably would see the S&P rising. Of course, we know that, and we can see that result here. But also what I can do is I can look at these lows below the 1 line and say, well, these might be corrections in the market, or these could be bottoms in the markets, or they could be the beginnings of new downward trends. So what I would do here at this point would be add the S&P to see if I can make those connections. And the easiest way to do that is come up here where it says compare, and I can open up here and add one of those major indexes that we're going to look at. In this case, we're going to be looking at the S&P 500. And there it is. And again, what do we see? An advancing market that has a positive advance decline ratio for a long period of time. Now, what did we see here? Well, there's that correction, right? We had that correction where the advance decline line briefly fell below that 1 value and then quickly recovered it, and then our trend was continuing. Now, what I see here, though, in terms of big picture, and this is really where breadth helps us in that big picture analysis, is my advanced decline ratio is trending lower. So yeah, this is trending lower. Now, that's not necessarily a bad thing, but it does mean that market participation or breadth is waning. So that might put into question this rally that we're having, especially because we're making new highs, right? We're making new highs in the S&P. We would really like to see this advanced decline trending higher, right? So this would be a divergence, right? Rising stock prices, falling breadth indicator. All right, so let's go back to our momentum page, our details. And again, we talked about declines of all total stocks. Let's kind of granularize this here, and let's just go and look at the Amex. Now the Amex is a good substitute for the S&P. So we can kind of talk about these interchangeable. So I'm looking at the advanced decline ratio for the Amex, or really what we're talking about is probably more like a broader picture of the S&P. All right, so there's a lot going on here. So let me just break this down again for you piece by piece. Again, I've changed my chart to a line chart. And again, we have a lot of noise here, right? So let's smooth this out. So I'm going to show you a technique now that how I use this for short-term trading, for momentum trading, for let's say swing trading. Now you could probably use this for day trading as a bias, but I'm really talking about somebody who's trading from week to week, or maybe holding positions from week to week, or maybe a 2-week period at the most. So what I'm going to do now is I'm going to look for extremes, and those extremes could be a sign of opportunity for me. And the extreme that I want to look for here is at the 0.05 level. So what does that represent? So I've drawn this line in, right? This does not come with this symbol. Well, zero point 0.5 means that we have 2 declines for every advance. And so that would to me could be a correction period or maybe a beginning of a downtrend. So again, I'm going to smooth this out, this data that I see on a day-to-day basis. And because I'm a weak trader, I want to look for a trend or a moving average that is less than a week or less than 5 days. So I'm looking at a 2-day exponential moving average. And again, I had this already lined up, so I'm going to turn it back on. And again, a lot of noise here. So let's turn off the daily noise. And now I'm just looking at a 2-day exponential moving average. And again, you can see where we've got to that extreme, that 0.5. So here's the trading rule that you can use of this. 2 out of every 3 opportunities of this setup, you will see when the moving average recaptures the one line, or that equal advances decline. Now I make my one line 1.02. I want to really see it above that. But if when it recaptures that 2 out of 3 of these signals, the market will be higher about 10 days later, or 10 bars later, since we're looking at a daily chart. So let's do that. Now, if you're not familiar how to draw a time bar, as I have up here, it's in this drawing tool section here, and you can see where it says date range. And that's all I did, was I just drew that. So again, let's look at some of these opportunities. Now, wait, first I missed one thing. We gotta have our analysis in terms of our S&P, again, our compare. So I'm going to add that, and that's what I've done. So here is the first one. And so there's where it got to that value. I'm waiting for when the S&P, the moving average recaptures the one line. And you can see on this example, it worked. Here we have it here. We recaptured the one line here. And on this one, probably about even, break even. Here, again, we have that 50, about 0.5, we regain the 1. And if we look at that, whoops, right there, again, you can see the market is higher. So I don't use this as a trading system for trading the S&P. I really use this as if I'm looking at an individual stock and I see it's in a correction or it's coming into an area where I feel like I want to purchase that stock, I want to see this condition, right? This condition of the market regaining that short-term momentum, that breadth indicator, and this is a good tailwind that the trade that I'm about to enter into will have a better probability of working out during that short time period, that 1 week or that 2-week period, because I'm going to catch the tailwind of positive breadth in the S&P. Okay, so let's do this. I see a couple questions here. I do want to try to get as many too, but please be patient here. I want to really get through a lot of different examples how we can use breath symbols. So below here, down here, is a new panel. And now this panel, what we're doing here is called an expression or an FX. And you can see that it is up here. And what I'm going to do here is I'm going to create an expression based on two breath indicators. And the two breath indicators that I'm going to be using was the ratio, the advanced decline ratio, and the AVRT, which is the advanced decline ratio in terms of volume. And if I divide that, that is what is called the ARM index. And that was created by a technician whose last name was Arm. But if you're have a trading platform, you might see that ARM's index is of a symbol maybe called a TRIN, TRIN, but that one is based on the New York Stock Exchange. This one we're looking at the Amex. So that is creating that symbol. So if you're not familiar how to do that, create this expression. So there is that expression, the $ADRA and the $AVRT, those expressions of those two special symbols. And creating expressions is real important that you remember that you need to always bracket the symbols. And you can just do symbols of stocks. You can do symbols of futures markets. And we do have a lot of very popular expressions or spread symbolology. So what I'm looking at here is the ARMS index. And so this was a theory that we're going to look at this in terms of a big picture, and this is really for my investors in the room. And let's do this. I'm going to turn off my moving average, and I'm going to turn off my, I already have it turned off, my symbol from above. And what we're just concentrating on is on the arms. And what the theory here is, and again, I drew this line in here. When the arm gets above 2.65, that is a potential buy signal. And that over the next 6 months to a year, again, for investors, the market will be higher once you get one of these 2.6 signals. But again, like a lot of breadth indicators, the breadth indicator might spike before the market bottoms. And this particular one, recently, a couple times, we have seen that there has been large drawdowns. In other words, the market continues to move in that direction before it eventually turns around. But you can see how it has picked many bottoming lows, and that 6 months to a year later, the market is higher. And again, you can see that recently, back in December of last year, we got that signal. So now we're about 6 months out. So again, you can use that as that one. So that's a way how to use special symbolism, create expressions, and also looking at a much bigger picture. Okay. So about back in November, I had an opportunity to interview Dr. Alex Elder, and he shared a couple of his breath indicators. Now, that webinar is linked to today's webinar. So when you go on to archives and you see today's webinar, just below that, you will see the link to the Dr. Elder. So if you really want to understand how Dr. Elder's created this next breath indicator, it's important that you go there for that precise meaning. But let me pull this up so I can kind of walk you through it. So there's 3 panels in this one, and the first panel is just the S&P. Now this S&P chart in Dr. Elder's is surrounded by Keltner bands and also two exponential moving averages. Now, you don't need to understand what their purpose is to understand this setup signal. And then we have two other panes and of special symbols, the F1HX and the F1LX. So let me show you those, and then we'll come back to this chart. So if I go into stocks under highs and lows, and I click on the summary, and I know some of you are going to forget about this. Remember, you got to go to the summary. If I click on the summary tab and I go down to the bottom here, what we're seeing is a breadth indicator of new monthly highs and new monthly lows, but this is based on a market capitalization. And so if you think about this, this kind of makes sense, right? We want to see those large cap stocks making new monthly highs. So we figure that this is a much better breadth indication than, let's say, a lot of small stocks or small cap stocks or penny stocks. So here we're looking at market capitalization. So again, here you can see here's that F1HX, F1LX. All right, so let's go back to this chart. So how do you read this one? Well, what we're going to wait for is when the new monthly lows by market capitalization gets above 20,000. Again, I drew this line in, this 20,000 value on my pane. Now notice that we had 3 times where the market spiked above 20,000 as the market was trading low. Again, a lot of times these breadth indicators will peak before the market actually makes that reversal. But the key here is now we're waiting for that market capitalization breadth on the upside. And what we want to see is new monthly highs above 20,000. And that's exactly what we see here. So there would be your confirmation or your buy signal. And again, you can see it here versus here, here versus here. Again, 3 peaks. And not until here did we get that confirmation. Now, what I find really interesting is just recently, where we had our correction in the market back in April, we got that signal. And just recently, in a few days ago, last week, as we were probably taking out all-time highs, we got that confirmation. So again, this indicator is telling us that there is some good, strong breadth based on this monthly indication. All right, so that's Dr. Elder's. So let's do this now. All right, so we talked about advanced decline number of stocks. We looked at volume. We looked at ratios. So let's now break this down in terms of performance, in terms of, let's say, sectors. So here I'm under my stock page where I'm looking at market performance. And this, whoops. So this chart here shows you the different sectors in the S&P. And let me show you this. So since about February, you can see here I'm on February 5th, the best performing sector has been, this blue line here, has been utilities. So let's check the breadth of utilities. Okay, so I'm going to go back to my special symbols. And here we are, sectors. And here's utilities. So I'm going to open that up. And we said since February. Well, February was about what? 3 months ago. So let's check the breadth of the utility market over the last 3 months. And again, the first time you open up one of these breadth indicators, you're going to see or these special symbols, you're going to see a lot of dots. And that's why you need to change your chart to a line chart. And so what we're going to do on this one is we're going to look at two ideas. One is extremes and the other is divergence. So first of all, let's start off by, you're just going to have to take my word that there was 30 stocks in the utilities sector. So if we're looking at a 3-month high versus low, that difference, right? And we get to an extreme. In other words, here's 25 on this side and 25 on that side, right? There's only 30 stocks in here. So we're talking about a large percentage of the stocks in that sector that are performing, either making new highs or making new lows. So again, I'm going to look at this over a period of time. I'm looking at 3 months. I need to smooth this information out. So I want to find a moving average. So I want to choose a moving average, and this is how you choose moving averages when you're doing market analysis. You want to use a moving average that is smaller than the time that you're going to analyze. So 3 months, that's about 60 trading days. So I want to use a time frame that's lower. That'll allow me to identify trends and still have time to take advantage of them. So I have a 10 period or a 10-day exponential moving average. Again, I've already had this lined up, loaded up, and I'm going to turn on that moving average. Again, I think where we can use this here is when the market gets to extremes in terms of looking for buying or selling opportunities, I probably want to see the moving average recapture that zero line. In other words, getting back to kind of a neutral. Now, what we do see here is there have been multiple spikes to the downside as well as to the upside. So let's now do a comparison. But instead of comparing, let's say, one of our major indexes, let's compare our specific symbol. The SRUT is the symbol for our utility sector. And notice how this has a very uncanny way of predicting tops and bottoms. Again, I think the confirmation of these tops and bottoms is as our moving average falls or recaptures that zero line. Now, this is what is kind of interesting in terms of our recent development is you can see that since about April or so, we can see that the utility sector, the blue line here, has been rising on rising moving average. More utility stocks are making 3-month highs. That's a good sign, strong breath. But what has happened in the last couple of days or in the last week or so is we got to an extreme, and now our less stocks are making new 3-month highs. And matter of fact, you can see today we'll only see one stock is making a new 3-month high in the whole sector. So what would this be? Well, this would be a confirmation of divergence, right? And this could mean that the breadth of this particular sector is waning. Now, it doesn't mean that this trend is over, but if I was an investor in utilities or I was looking at opportunities to buy a utility, I would probably be waiting for some kind of correction, either a correction in the sector itself, or I would probably want to see that our moving average stops trending lower and starts trending back higher. Okay. All right. Woo. Run, 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 run. Let's do one more example, and then Gene, I will definitely answer some of these questions. Okay. All right, so let's go back to our market performance page. And if I scroll down here, here's where we're going to use that breadth indication of looking at number of stocks above a moving average. And you can see that there's a lot of ways we can do this. We granularize this by different moving averages. And I said to you that the 50-day moving average is one of my favorite moving averages to do this analysis. But just looking at this outright, this page outright, you can, this is really just tells you the breadth of the market, right? You can see the different sectors, and the more green, that means more participation. That means that's good, strong breadth. But too much green might be an extreme. And notice if we look at our utilities, right? All the stocks in the utility sector are above their 50-day moving average. Not necessarily a bad thing, but we are at an extreme. So if I click on any of these symbol boxes, and here we're at the S&P 500 index, I'm going to click on this. I'm going to show you this kind of cool little technique that I use, where I'm going to change this special symbol, $S5FI. I'm going to change this into an oscillator, very similar to, let's say, an RSI or a stochastic. Okay. So the first thing I want to do is I want to find extremes in this moving average concept. And so what I did is I drew these boxes in here, similar to values that we would see in, let's say, an RSI or a stochastics. So I want to see when 80% of the stocks are above their 50-day moving average, and or 20% are below their 50-day moving average, okay? And again, a lot of noise, right? A lot of different noise here. So how can we smooth this out? Well, let's use a moving average. And in this case, I'm going to use a 5 period, right? I want to see what is the moving average over a week. I feel like that is a really good measurement in terms of this type of analysis. Again, I've already lined this up, and I'm going to turn that on. Now that I've smoothed it out, I don't need that noise from day to day. So there is my moving average. So now what I'm going to do is, there's kind of this rule that you can use is, if we get into the overbought territory, similar to like a RSI or a stochastic, when it falls out, there's something called like the 80-60 rule, which basically says once it falls out of 80, it should fall to 60. And if it falls through 60 and goes past the 50 line, it should go to the opposite extreme. And on the other side, if it falls down below 20, it gets back above 20, then it should move back closer to 60. And then if it gets back 60, it'll go back to 80. So I'm looking at extremes, but also I can use this as a looking at divergences. So I'm going to compare this to the S&P, which is what it is, right? We're looking at the S&P moving averages. And again, I've already got this teed up. I'm going to just turn on my eyeball, and there we go. And this is really kind of amazing how this does a really good job of picking tops and bottoms, picking tops and bottoms. And again, remember this breadth indicator, as many breadth indicators, lots of times it will peak or trough before actual prices. So you need some types of confirmational information. In other words, probably on these ones, I would be looking for, multiple days outside of these overbought or oversold conditions, or wait for, on a chart, let's say, break out above a new week high or a new monthly high, or break out of a weekly low or a monthly low to give me that confirmation. Now, what's kind of interesting though is, of recent though, we did have that overbought signal where we fell out, held 60. We did not get back into overbought and then fell below 50. So this again is, as the S&P is making new all-time highs, we're getting a divergence, right? We're seeing less and less stocks above their 50-day moving average. Again, how would I use this information? Well, if I'm investing in the S&P right now, I think I'd be waiting, right? I would either wait for what? A correction in the S&P, or I really would like to see this moving average start to get above 60 and moving towards its way towards 80. What would be the cautionary tale? Well, if this starts to fall back down towards 50 as we're making new all-time highs, I would probably be looking for some put protection. Okay, so I know I went through a lot of stuff here, and again, one of the nice features about all of our webinars is that they are recorded and you can watch this over and over. But I did show you a lot of cool, what I believe cool um, tools that you can use in terms of market breadth. So let me get to um, some of your questions.
While John is
Chris,
reviewing, oh,
yeah.
go ahead.
No,
I
go
didn't
ahead,
know you were
Gene.
ready. I was just going to say, a couple people have asked whether everything that you're demonstrating, if it's available for free membership or if you need a Bar Chart Plus or Premier membership. And everything John is showing you, these charts are available with a free membership. I've been pointing out, though, that free membership only gives you one chart template. I know, John, you use templates an awful lot. So if you're interested in trying out and saving multiple chart setups, feel free to take a free 30-day trial of Bar Chart Plus or Premier. Okay, back to you.
All right, so Christopher's asking about Fibonacci numbers. Christopher, we have a webinar on Fibonacci's. I would refer you to that in terms of, if you're looking at extremes and in terms of breadth indicators, and then you go to your chart and you want to use your Fibonacci numbers to kind of confirm or that cluster of evidence of highs and lows or bottoms or potential breakouts, then I think that would be a great tool. BC, BC, I hear you. So where's the summary, and is it's complicated, and is there anything more simpler? And I apologize that I can't really make this any more simpler. I mean, I could break down one or two of these, but again, what we're really kind of looking at is how we can use a lot of these different tools that we have in our toolbox and our special symbols, and how just give you some ideas of how you can create your own breadth indicators. Wayne asks, can we integrate weighted alpha into various advanced and decline analysis? Wayne, I haven't thought about that. That's a great question. I'm sure you probably could, right? You could think about what is an average alpha versus the S&P, and then if you're outside, then that would be kind of a momentum breadth indicator, right? If your stock is alpha is greater than the S&P, then it has greater momentum. Or if that alpha starts to change at an extreme, especially during the times when the S&P or the broader indexes are showing divergence, then that might be a great way to use that. I'd have to think about that one, Wayne. Good question. Okay. So I think we got most of this. Again, if I didn't get to all your questions, you can send your questions to support@barchart.com. If we don't get to those questions today, we have a great staff, and they will send those to me. All right. So let's go back to our slides. So again, in our slides, there's that setup of the elders indicator that I showed you. There was another one I didn't get to today, which was using the 52-week. Again, I watch that webinar to learn how to use this one. And whoops, here we go. All right, so let's do a quick summary here and takeaway. So breadth indicators are definitely powerful tools for assessing market health and confirming trends, identifying potential reversal, and gauging that strength of market participation. But like all technical analysis and all technical tools, they are not infallible and should be used with other analytical methods for comprehensive market analysis. And I think the main takeaway that you should realize is that breadth indicators typically trough and peak before prices do. Okay. I hope you enjoyed today's session. Next week, we're off for Memorial Day weekend. I want to wish everybody a happy and safe Memorial Day weekend. Gene, I want to thank you again for being my moderator, and I hope that you have a wonderful cicada-less Memorial Day weekend.
I kind of doubt that, John, but thank you, and I hope you have a great weekend too.
All right, until next time, folks. Uh, you know, best of health, manage your risk, and the good of all trading.